I am Rob Goff, the head of research and the tech telecom analyst with Echelon Capital Markets. I am very pleased to be here today with Shaune Maine, the CEO of Converge Technology Solutions. Shaune, thank you for being here with us today.
Thank you, Rob. Pleasure.
Now, before jumping into the Q&As, I just thought I would give a few bullets on Converge to sort of set the stage for our dialogue. There are a lot of bullets I could have put in, but we'll just keep it to a tight number. Converge is a leading hybrid IT solutions provider in North America. The company completed its first acquisition in October of 2017. Since that time, it has made a further 11 on-strategy accretive acquisitions, so you have definitely been busy. You've set yourself to a point where you're pushing $1 billion in revenues for the current year. In terms of your stock, it started trading on the TSXV in November of 2018 with the ticker CTS. In terms of the capitalization, the current capitalization with a share price of $1.40 is roughly $130 million. As for Shaune, I won't do justice, but to be brief, prior to Converge, Shaune was the COO of another public IT company where he ran a $700 million revenue IT service provider. So we are all here to have your views, your perspectives. So with that, Shaune, shall we just dive right in?
Let's dive right in. Sounds great.
Okay, thanks. As I noted up front, you've been very active. You've made 12 acquisitions since October 2017. That's both impressive and daunting. Can you share with us some of your key takeaways in terms of how you've made these integrations work?
So number one, you always have to start with culture. So we're really fortunate that the companies are all from our industry. They've been around for 25 years, and we meet them all at the vendor conferences. So we've acquired 12 of the 84 companies that I've met with in our target market size, and we've known them all. And then the other key takeaway I would mention is never change comp plans or brands during the first year after acquisition. A lot of very well-known acquirers do that and end up losing salespeople. We've lost no key salespeople that we've acquired in all 12 companies because of our approach. So start with culture and be very careful of the changes you make in the first year.
Okay, thank you. Maybe if you could dive a little bit deeper, could you discuss how you've been able to realize tangible revenue synergies in addition to cost synergies? Thank you.
So yeah, be great too. And we start with revenue synergies. The key is if you have to train up the salespeople and engineers in an acquisition company on doing something new, that takes a long time and is difficult. So our president, a guy named Greg Berard, who came out of our Lighthouse acquisition, he runs now all of our sales, marketing, and engineering, has a much better pre-sales model. What he does is he takes our leading technology, so Red Hat is one of our key partners, and he'll do a roadshow with Red Hat or our cybersecurity practice at each of the cities where we have offices. The local salespeople and engineers, they invite customers to come to us. Large enterprise wouldn't do this, but in mid-market where we specialize, they will. And we started off between 25 and 40, got it up as high as 65, and during COVID-19 it's now virtual. But when you bring them to you, those local people only have to know a note about Ansible, Red Hat's management platform, to get the people to the meeting. Then we have the world-class experts take them through a workshop for a day. This pre-sales model is so much more efficient and effective, and also rebrands the acquisition to these hybrid IT technologies that we're bringing these customers to. So that's a very different approach that has led to these great revenue synergies that we've seen, especially around our hybrid IT capabilities. And hybrid IT means I sell public cloud, I sell private cloud or managed services, and I sell a lot of the practices like analytics, cybersecurity, and DevOps or cloud migration services. So those are the kind of key capabilities. So the second part you asked is on the cost synergies. We turned it around, and cost synergies only came in phase 3. So we bought the 12 companies and now we're integrating them. So this year, and even during COVID-19, we're integrating all 12 back offices. Actually, on Canada Day, July 1st, we integrated back office 6 and 7, and all 12 will be done by December the 1st. So that takes $9 million of cost out. And on the beginning of April, when you buy 12 companies, there's duplicate management teams, sales, marketing, and engineering. We removed $11 million of annualized cost. So we're taking $20 million of cost out. As you said, consensus revenue about a $1 billion company, or 2% of cost out from the platform. But we waited until phase 3. First cross-sell, grow your gross profit, and then focus on the cost synergies.
Okay, very good. And the results speak for themselves.
Yeah.
There, in terms of sourcing the acquisitions, can you perhaps give us an idea of how you develop the pipeline? Are these competitive bidding situations, and what sort of valuations and accretion expectations do you have?
So we've never been in an auction process. We know all these companies. So I've gone in, as I mentioned, in Med84 and said, and when you're ready, give us a call. They get approached all the time. The thing is, private equity doesn't play in the small space. So the people that are trying to play financial guy in our space, there's a lot of carcasses of companies that have been acquired by people that didn't know what they were doing and wreck them. Then you've got some of the guys that are like, they want to, like a Sirius or Presidio, that will acquire you and amalgamate you and wipe out the management team. Well, they're not as keen about their legacy being left like that. So our model, where we're from the industry, we'll bring a lot of more capabilities to sell, but we leave the existing management teams in place, just put someone over top of them to do a lot of the cross-sell, has been a really effective model for us. And therefore, we get a lot of referrals from our pipeline, and we encourage them, talk to the companies that we've acquired. And they find out it's worked out very well. Their salespeople are making more money. We treat people with respect. This culture mesh is really, really important. So our biggest success in attracting companies to want to become part of this roll-up has been the success by which we've done the ones to date, and our reputations in the industry.
And may I ask, as a follow-up there, how has COVID-19 impacted that pipeline and the prospects there?
So we have a very full pipeline that we put on hold. So we buy 4 to 6 companies a year. We've averaged 5 a year. We bought one in February. We were going to do one in March and pushed it off because the company had some exposure to oil and gas, which is a sector that was hit quite large. And we're very fortunate. 77% of our revenue in Q1 came from sectors that haven't been impacted: technology, finance, healthcare, and government, and state, local, and education. Now the other 23%, the next ones for us are no one sector has more than 4%. It goes industrials, utilities, and down. So as a company, we haven't been exposed, but other companies have been exposed to the wrong sectors. So we said, let's take a pause in Q2 and continue to talk to those acquisitions, and then get back on the acquisition trail in Q3 and Q4. And what we're finding the industry is doing now is putting a one-time COVID charge against your trailing 12 months. So we base valuations on kind of 4 to 5 times trailing 12 months EBITDA. But I can't give you credit for what happened during COVID-19, so I'll take that out of the upfront purchase price, but we usually earn-outs, and so I will add that piece to the earn-out if you can go back to the levels that you were at pre-COVID.
Shaune, as a deeper question there, could you confirm or talk to how these acquisitions have or have not been accretive, and what steps you can take to ensure that they are accretive? Thank you.
Great. So when we buy these companies, they are making approximately 3% EBITDA of their revenue. As soon as we acquire them, we then make them top-tier certificates with all their main vendors. When you have size and scale, you get much better volume rebates from them. Last year, on my 687 million of revenue, I had 10 million of volume rebates, or 1.5%. That's the way I take a 3% EBITDA company and turn it into a 4.5% EBITDA company. And then this year, we're taking 2% of cost out, 1% from the front office, 1% from the back office. That's how I take a 3% EBITDA company to 6.5%. And so when you buy a company, let's say for 5 times, and then you take their EBITDA from 3 to 6.5, that's the way I get them down to kind of 2.5 times when you include synergies.
Okay. Thank you. And that actually works as a very good segue into the next question, not by planning. In IT services marketplace, where there is a general view that growth is single digit and margins are double digit, how are you looking to produce double digit on both fronts?
So first, the growth that you experience in the public cloud marketplace is much greater. So if you look at the Amazon's, the top provider of public cloud services, their growth rate is in the kind of 35%. Microsoft with Azure and Google with their GCP platform are more in the kind of 60 to 70% growth. So a cloud services company has an underlying growth rate which is very healthy, double digit. The second part is the services around that. I mentioned my analytics, my cybersecurity, my DevOps, my managed services. Their margins are in the 30 to 40%. My gross profit is 23%. When you compare me to the people that sell a lot of hardware, the CDWs, the Insights, the Pivots, they're in the 13 to 16%. I look much more like an Accenture, a CGI, or an Alithya, which are kind of in that 30 to 40%. So as we sell more of these consulting migration services, more of our recurring revenue, more managed services, that's when you see my gross profit go up from my kind of 23 to 25% gross profit to what we're hoping to do is closer to 30% gross profit.
And that all gets into your definition of being a hybrid IT services company.
Exactly.
And the key point of differentiation for you in the marketplace. Well, thank you. You've touched on it a bit, but could you perhaps go over the full benefits of scale in terms of vendor relationships? Please.
Yeah, so you're absolutely right. So we're number 50, believe it or not, in the IT service providers in North America, which means there are very few large ones, and yet this is a $1 trillion marketplace in the US. So there's many, very fragmented marketplace. The way the vendors discriminate to the larger providers, because they want size and scale in order to run national campaigns, is they provide better pricing, they provide better rebates, which I was going through, but they also provide to growth partners market development funds. And what we do in providing these road shows, which are paid for by Red Hat, by IBM, by Cisco, by Dell, to run these national campaigns, is they're funding it because they're getting net new logos, people that don't use their technology today onto their platform. So last year we had 3.5 million of market development funds in addition to the 10 million of volume rebates. The companies before we bought them in aggregate got less than $1 million of these type of funds before we bought them. So this is all additive and shows how the size and scale that you have can be very accretive to your company with the vendors.
We're good. If we go even one layer deeper, because I know there are multiple layers here. In a follow-up, can you discuss with these vendor relationships, the benefits of diversification, and in terms of the balance of business flows, in terms of business that they would refer to you, and if you are booking $1, what are you directing their way?
So the one thing I'll say in the public cloud space, we focus in on Red Hat and VMware, which are the operating system, which means an application doesn't have to know which public cloud provider it's on. So you've got Red Hat, which has their containers or Kubernetes, which an application sits inside, that if it's on Microsoft or Amazon or Google, doesn't make a difference to the application. So I'm in my managed services, it's VMware and their virtual machines where applications are on top of those. So that's the layer that by being, that's the vendor of choice for me. I'm agnostic on the public cloud providers. It does mean that, so Quisitive, who is a Microsoft only partner, they're a lot smaller than we are, but they'll get leads from a Microsoft. Whereas for us, I'm getting my leads more on the Red Hat and the VMware side, because I want to get involved at the application layer, not when someone's choosing infrastructure. So if I'm there, when they go as a mid-tier company, if they go to choose, does it stay on premise? Does it go in the private cloud or a managed service or a public cloud? I'm there to make that recommendation. And if it's a Microsoft application, it'll work best on Azure. But if it's a back office application, I wouldn't put it on Azure. I'd put it on GCP, Google's cloud platform, or AWS. So in that way, we're able to do the right thing for the customer and give them a hybrid or multi-cloud solution. So I'm not saying that everything is always going to be Microsoft, because I don't believe that's actually true in the best interest of my customer.
Okay. Thank you. Now, could you, in diving into your revenues, address your client concentration, recurring, and cloud mix, just to give us a bit better feel for that?
Great. So as I was saying before, in Q1, we had 23% of our revenue came from financial services, 23% from government and state, local, and education, 21% from technology companies, and 10% from healthcare. Of the other 23%, not one sector made more than 4% of our revenue. It went then utilities, industrials was 3%, and then down from there. So wonderful diversification. Also, in Q1, 81 of my customers bought at least $1 million in revenue of my products and services from me. 840 of my customers bought at least 100,000. So we've got this wonderful diversified mid-market base. That means during COVID-19, one of the reasons we've been so resilient is because of the diversification. We're in good sectors, but also the diversification of the customer base. But also, of my 200 salespeople, it means on average they're selling to 4 to 5 people. So they're more hunters, technology savvy, younger than someone selling to large enterprise who's older and really farming one account. So I think that diversification is very helpful. We've seen incredible growth from Q4 to Q1. So as Satya Nadella, the CEO of Microsoft, says, he's seen 2 years of digital transformation in 2 months. Well, we're a case study for that. So our recurring revenue grew 36% from Q4 to Q1. Our private cloud managed services, which are 3-year contracts, monthly recurring revenue, are an annualized $52 million a year. That monthly recurring revenue, just take that number and divide by 12. Our public cloud revenues, and these are 3-year contracts from Amazon, Google, and Microsoft, are $59 million annualized, and those are gross revenues. And then $79 million is from when you sell software like IBM's Watson Analytics platform, or their security platform called QRadar, or Cognos. You get a recurring revenue piece for providing patches and upgrades. And that was $79 million. So in total, that added up to about $190 million gross, or $100 million net. In my Q1 financials, around 21% of my revenue is classified as services on a net basis, and then the rest is made up of product revenue, and that is both software, which is over 20%, and around 57% of hardware.
Okay, thank you. Could you provide your perspective on offshoring in terms of enabling 24/7 service or as a cost efficiency measure?
So I do not believe in offshoring due to customer experience. I believe in nearshoring. So I can be much more effective cost-wise by using Canada and Mexico, which are in the same time zone. And even then, I'm always very cognizant of the customer experience. If you're outsourcing a language or culture problem where I'm on a customer service line and I don't understand my customer's environment or what they're going through, that gap can cost you customers. So the cost base isn't worth it. If I can find cost efficiencies through geography, one, by putting places in the right places in the US, but more importantly in Canada, and also now we're exploring on a managed service side in Mexico, I believe I can get a much more effective customer experience. Managed services revenues are great and they're sticky. The only way you lose them is if you don't provide the right customer experience. And therefore, I'm very leery about providing outsourcing, and especially now to, say, outside of North America, especially now also when COVID-19 has naturally close down borders, cause some trade kind of restrictions and tensions, that I think it's also a much more prudent move to stay within North America.
So looking forward, can you talk to what your strategic priorities are, both in terms of organic growth and in terms of inorganic growth through acquisitions?
So we've always said 4 to 6 acquisitions are kind of our norm. We bought one in Q1. We'll get back on the acquisition trail in Q3 and Q4. We took a pause in Q2, but last year we bought one in Q1, one in Q3, and 3 in Q4. So I don't view it that different. Organic, we've always said our goal was kind of in the end of phase 3 to get to 2 billion of revenue and 100 million of EBITDA on a run rate basis, kind of the end of next year. If you acquire 400 million of revenue this year and next year is where you kind of get to inorganically. Organically, we model in kind of 17 to 18% gross profit growth and 10% revenue growth. That's because the new things we're selling, hardware has got higher revenue and lower margin. We're changing that out for higher margin services and managed services that have lower revenue. So that's the kind of mix you get to. So that's kind of our goal, is continue to do the acquisitions that we're doing, continue to grow organically. Really, the cost out is the major difference this year. And when you see our Q2 numbers, you'll really see that cost out piece, as we took 11 million of annualized costs from the front office out at the beginning of Q2, and we continue to integrate these back offices. When you take out 20 million of cost in a year, that's 5 million a quarter when you get to the end. That's a meaningful, considering our EBITDA last year was 31.5, that's a meaningful impact to your EBITDA.
Very good. And in terms of the acquisition strategies, are you prioritizing any products or applications where you're looking to strengthen your portfolio? Is it geographic reach? Is it specific clients? Or?
Well, in phase 1, our first phase, it was about broad brush geographical coverage and top tier with my vendors. In phase 2, it was around all the capabilities around hybrid IT. Those 3 public cloud providers, make sure I've got practice areas around that. Analytics, cybersecurity, DevOps, and my managed service. Now, it's really about scale. I want to hit all the NFL cities, and it becomes much more about hitting more of that. We only hit 0.1% of that $1 trillion US market, the mid-market and SMB I'm going after. So it's much more about customers, and I'm starting to do it now, not just through acquisition, but organically as well. Earlier this year at Toronto, we grew a sales team organically. We're looking to do that more. Where you already have infrastructure, you can also grow organically, whereas it's better to do it through acquisition where you don't have a physical presence.
Very good. And I guess in terms of a closing question, if I can put it over to you broadly, is there something that you would like to highlight or you felt that you anticipated I would be hitting you with?
So one of the real things we're just launched that I'm extremely excited about is our Trust Builder platform. So this is a set of 11 APIs that allowed trust to be built between counterparties, that our Becker Carroll group, which we acquired in early January of 2018, has been developing around solutions for the Canadian federal government as well as in Quebec, and we'll be offering it to municipalities in Quebec. During COVID-19, it's much more important to have a counterparty trust. So some of the assertions, we talk about building these trusted networks of people. An example that the Becker Carroll guys will talk about is how, the US admissions scandal where people were saying that my kids does a professional sport or plays a sport and gets a scholarship to get into a university he wouldn't have otherwise gotten into. Well, there was a false assertion that their child was an athlete. That's an example of these networks where do you have an assertion that can be validated and verified using this platform, such as if you're doing procurement to the Canadian federal government, and one of the requirements is that you have to be of a certain size and scale, say 100 million, we can go check with Revenue Canada to make sure you are in order to do that process. It's validating claims. And so you can build up in a trusted way claims back and forth between parties. And so this is something that's brand new to us. This is our own IP, which is very different from the traditional model that we've been building out. We'll be rolling it out in Canada first to municipalities and then in the US and into our managed services. So really excited about that. And that's in addition to our standard model where we've been really taking IT service providers and making them hybrid IT providers.
Very good. And so in recognizing the time, Shaune, I would like to thank you very much for your thoughts, your perspectives, your time. It's been very exciting. And, we look forward to working together and watching everything unfold as well as it has been going. The momentum is fantastic.
Wonderful. I look forward to giving my Q2 results in kind of the middle of August.